How sequence of inflation risks can hurt your retirement plan. Your old buddy Josh, I tell you, man, this is the place to get the freaking. Look, you got to be here. You got to be here every day. Chuck out there today said, dude, I watch all of your videos, but I can't watch them all. How dare you? You got to be here every day. Because I'm bringing heat to the financial planning arena that no one else has done. So I wrote about this in my book, Relax and Retire. Go see my finger. Ouch, ouchie. I wrote about it, Relax and Retire, Debunking Inflation Fears. No one else talked about this until your old buddy Josh did. I need a Nobel Prize in financial planning, just like my man Ty Bernicki. No one else talked about retirees spending less as they age until Ty Bernicki made an article about that in the Financial Planning Journal for Financial Planning in 2005. There was one couple out of, I want to say UC Berkeley or something like that, I can't remember, who was talking about that, but no one else did, at least in terms of mainstream financial planning that I read. Now, 1999 was when that couple from, it was UC Berkeley, UCLA or something like that, they had written about it. That was before my time. I wasn't part of I wasn't reading the JFP, the Journal for Financial Planning. So I would give them credit. I just can't remember the name. For me, it was Ty Bernicki who came up with the idea that as people age, they spend less. But no one talks about Ty Bernicki. It actually ticks me off. It's like, how can you not talk about Ty Bernicki? He's the guy who started this whole steamroller. Anyway, so I'm the one who started the whole idea about sequence of inflation risks in my book. In fact, I posted a comment on Advisor Perspectives, 6 months or something like that ago, maybe a year ago now. My man Joe Tomlinson had written on it. As you know, he responded to my questioning, like we need a Monte Carlo for inflation risk, like we have for investment return risk. I think Blanchett might have too. Maybe he didn't. But I remember Joe Tomlinson, who I'm a big fan of, Blanchett, a couple of maybe Edison's, I can't remember. Anyway, the point being is no one's talked about that. Inflation is not a 3% fixed thing. It's just not. It varies. And not to get, it's insane. So if we're going to have, let me just give you an example here. In the bad old days of investing, we used to have assumed a 10% rate of return. 10% each and every year. All right, this is before Bill Bengen's 4% rule came out in 1994. And then the Trinity elaborated on that study in 1997, the Trinity study. And that's where they get about 4.4%. But before that, we're just using a simple 10% rate of return. And so essentially we said if you're taking 8% a year, all right, you're adding to your capital this amount right here. So we could say if we assume a 10% rate of return, like historical numbers, you can take 8% a year out without even touching your principal, still adding to it. Well, we know how silly that was. It just wasn't true. What we know is returns go like this. Oh, man, it really still does hurt my finger. It goes like that. It's volatile. And as such, if you're taking 8% out here when the markets are down, you could quickly find yourself in a world of hurt, like in 2008 or even 2022. Or 2000, 2001, and 2002. Well, inflation's the same way. It's not nearly as volatile with a standard deviation. Oops, hold on a second. Hi, baby. Hi, baby. It's not nearly as volatile as investment returns, but there is volatility. Just look at what happened this last couple of years. And so now we're finally starting to see people talk about that. So I want to show you something here. This was a pretty interesting, and I'll put a link in the show notes. Here's inflation, 100 years of inflation. Again, we're using CPI, which, I mean, you got to read my book, dudes. I mean, CPI is silly, but whatever. It's what we're going to use. And you can see right here, that's after World War II right there. You can see right here the 70s. Low inflation, a little bit of deflation there. 2008 was getting close to deflation. 2000 was that? It might be 2009, something like that. Huge inflation here, low inflation, dropping inflation here. But this is not a fixed 3% inflation rate each and every year. It's just not. It's freaking, you can't do that. And so he has who wrote this, by the way? Forgot his name. What's this guy's name? Justin Fitzpatrick, PhD. CFP, CFA, so a very educated guy. He's taught at MIT, at Harvard. Wow, all right, my man Justin. And he went to the University of Michigan. We won't hold that against him. He's got a PhD from MIT, so he's a well-credentialed chap, this old Patrick. Anyway, so I want to show you something here. This is pretty interesting. Right here. Effects of variable inflation on portfolio plans. Historical simulation. So I assume that's using historical rates of return. If we use a fixed inflation or variable inflation, you can see the fixed inflation gives us higher probabilities of success every single time. And here's your stock allocation, 100% stocks, 75% stocks. So a fixed inflation gives us higher probability of success every single time. So if you have, what's this, 90% with no stocks, 90% probability of success, or a 75% probability of success if you have no stocks, and one is a fixed inflation and one is a variable inflation. That's a pretty significant difference. Here's 25% stocks, 90 to 72, 90 to 79, 90 to 80, 90 to 81. So let me show you here. I mean, it's nuts. You got to have, how do we fix this? I don't know, but I'm going to share with you here just real quick. The high variability of inflation over the last several decades, with the high rates of the early 80s dipping to the low in the late 2000s, even a mild deflation in 2015 and inflation over 9% in 2022, makes a strong case for treating inflation as an uncertain variable in financial planning. Sequence of inflation risk can substantially impact a financial plan, and failing to consider this can lead advisors to overestimate sustainable spending and underestimate risk in retirement. 100%, man. Let's see. Though most plans are affected at least by some inflation risk, certain factors make accounting for it especially important. If inflation is expected to be high or especially variable or uncertain, or a plan has substantial not adjusted for inflation cash flows, pensions for instance, a higher bond allocation, or a higher probability of success, failing to consider the variability of inflation and sequence of inflation risk will likely distort plan results and make them less dependable. 100%, man. 100%. Ultimately, the key point is that inflation is far from a static factor and is just as variable and certain as other aspects of the plan, like investment returns. Could not agree more. He talks about when we started using financial planning, Monte Carlos, and for investment returns. Historically, inflation has not been steady, and it seems unlikely this will change in the future. Even with the lives of today's second graders, the U.S. has seen both mild inflation and deflation and high inflation. Again, we talked about that. I want to show you an example he got. The Smith family right here receives a $10,000 monthly pension that is not adjusted for inflation. It's their sole source of income, and they estimate that in their retirement it will last for 30 years. The family advisor assumes a 3% inflation a year, just a fixed inflation rate. The Smiths are extremely risk averse and prefer CDs. Of course, they're tempted to spend their whole $10,000 pension each month, but the advisor knows it would be prudent to have them put some of their money aside to counter the fact the future loss of purchasing power due to inflation. When the family asks their advisors how much they can spend from their income stream, the advisor uses a simple time value of money calculation, assuming the family will first save and then withdraw from the interest-paying account whose returns match inflation, i.e. 0% rate of return. So we're going to get 3% inflation, 3% rate of return. That's a net zero. You're not making any money. You're not losing, but you're not making any. The advisor estimates that they can begin spending $66.40 a month while saving the other $33.60 a month to offset the inflation over time. All right, so that's what we come up with. However, when the Smiths, in the example above, may be dismayed, they learn that they wish to sustain their purchasing power over 30 years in the face of 3% inflation, they may have to save more than a third of their money to offset the future inflation. During the last 100 years, inflation averaged 2.9%, but actual sequence of inflation would have provided the Smiths with real spending levels as low as $43.50 if they retired in the 1970s. Isn't that crazy? So right here, if they're going to spend $63.80 a month, all right, that's adjusted for inflation, they retired in 1937, they'd only have a 50% historical success rate. Whereas the advisor said they could spend 60, what did he say? 60, he said he could spend 66.40. And yet if they retired in 1937 May, they could only spend 63.80 and still only have 50% success rate. If they retired in April 1973 and they wanted 100% success rate, they could only spend 43.50. Average inflation, 5 years, average inflation 2.9. And I'll put a link to the article because it's fantastic. That's 100% right. The answer is, there's no, look, I don't know any software that does inflation Monte Carlos. I just don't know. So I'm not going to get all wrapped around the sheets here. Because he does talk, wrapped around the sheets? Is that what it's called? No, it's not wrapped around the sheets. Wrapped around the axle. What the hell's wrapped around the sheets? You got a sick mind, Josh. Wrapped around the sheets. What the hell? Wrapped around the axle? Wrapped around under my thumb? I don't even know. Anyway, but he talks about right here. If we have a higher inflation rate, I want to share you something here. Right here. If we used what do you say? This is so here he's using a 6.2% annualized inflation for 30 years. And we're getting pretty similar to what we had before. So 6.2 fixed. What's up, Grumpy Stiltskin? And it might seem weird. Like, how could we have the same spending at 6.2 fixed as we have 3%? And remember, because we're getting a 0% rate of return on the money we're saving. So the savings is getting 6.2, while inflation is 6.2 on this portfolio. This portfolio right here, the savings is getting 3%, while inflation is 3%. And then this guy says, this is analogous to how an advisor who wishes to find a sustainable withdrawal rate from an investment portfolio with varying returns, but uses a constant rate of return in time value of money calculation. So basically, our returns are volatile, but we're using a constant rate of return. That's analogous to that. And then he says, you would have to use a rate of return much lower than the expected long-term arithmetic average. For example, assuming a 5% arithmetic annual return and a 10% standard deviation of returns in a basic Monte Carlo simulation, $1 million portfolio could produce roughly $46,000 a year for 30 years with 80% probability of success. And these are using historical rates of return, by the way. To produce the same withdrawal rate using a straight line appreciation, we'd have to use a constant 2.3% real return, well below the assumed, why are you growling over there, Grouse, 5% arithmetic average. And that's, it's just, what's going on? So essentially you're saying your arithmetic average is 5%. If we're going to use right here, the same portfolio uses a straight line appreciation, you say you're only going to get 2.3% versus arithmetic. It's all the same thing here. That's always confusing to understand. It's okay if I'm confusing you. Just read the article. It's great. It's a good article, man. Lots of good content in that article. I don't have any solution in terms of how do you fix this. I don't know. I just find it interesting, and hopefully some people can develop software that can get this done. Because I'm telling you, using a straight 3% inflation, a straight 4% inflation, in of itself, that's not a winning scenario. It's just not, because inflation varies. That's why you got to redo your plan every year, guys. It's stupid. It's like speaking of Chuck, I talked to him today. I've talked to him every year for, I guess, 4 years now. He and his better half, and I won't name her name because she crushes. But anyway, they're kicking ass and taking names out there in the West Coast. Every year we got to make adjustments. It's just that fact. The idea that what I put in there today will stand the test of time for 30 years is freaking dumb. Why? Don't do that, man. You got to make adjustments. Sometimes you adjust for inflation. Say right now inflation is much higher than we thought, or it might not be. Sometimes you might say, look, we don't want to change it on a dime, but we say, we have a pretty good idea. So right now in the overall right capital, I use about 3.5% inflation. That's 5.5% for healthcare and 3% for everything else. We might adjust that up at the end of this year. I use it based on Vanguard's models, by the way. And if Vanguard's models adjust it, I typically do as well. So I adjust every year because you have to. Well, you don't have to, but you should for sure. Anyway, I know it's a confusing video, but I just hope you got to think about it in your head that using a straight inflation rate, that's just dumb, man. I mean, what's the alternative? I don't know, but you got to adjust it every year. Excuse me. And when I mean adjust, you have to review your plan every year. It's not set and forget it. That is dumb. That is dumb. All right, love your thoughts. We'll see you.